The tensions in the Middle East are escalating, and if you've been watching the markets, you're probably asking one question: is this going to get a lot worse? So I want to show you what actually happened to the stock market in the last 8 times a major war broke out, going all the way back to 1939. The data tells an interesting story, and once you see it, you'll have a clearer framework for thinking about what the Iran situation means for your positions right now. And at the end, I'll show you exactly why, if you're trading with a structured plan on a higher time frame, you don't need to second guess any of this. The plan handles it for you. So let's dive in. So this is a chart I want to walk you through. What you're looking at is the SP 500 indexed to 100 on the day each conflict broke out, then tracked over the following 12 months. 8 major wars, 8 lines. Let's see what the pattern tells us. The first thing that jumps out is that these lines go in completely different directions. Some shoot up, some crash. There is no clean story here. And that's actually the honest headline. It's kind of a coin flip. 4 out of 8 conflicts ended higher. 12 months later, 4 ended lower. The average 12-month return across all 8 was negative 0.9%, basically flat. The typical max drawdown, which is the worst point each line hit, was around minus 13.7%. So yes, wars usually create a painful dip at some point, but whether they end higher or lower a year later is generally uncertain. So what actually determines the outcome? It's not the war itself, it's a macro backdrop the war lands on. So let's look at some of the winners, right? So Korea 1950, the post-World War II economic boom was already running. Iraq 2003, markets were sitting at the bottom of the dot-com crash. They had nowhere to go but up. And if we now look at some of the losers, such as Yom Kippur 1973, the war triggered an oil embargo that sent inflation through the roof at the moment when the economy was already fragile. And Russia-Ukraine 2022, energy prices spiked at exactly the wrong time, pushing the Fed to hike rates faster than anyone expected. So the war was a trigger, but the pre-existing conditions are what made it catastrophic. So what does that all mean for Iran? Well, honestly, nobody knows yet, but history gives us a clear framework for thinking about these kind of situations. The bad case, the scenario where this gets really bad, looks like 1973. Iran sits right next to the Strait of Hormuz. Roughly 20% of the world's entire oil supply passes through that strait every single day. If this conflict escalates into a real disruption of that choke point, you get an oil price shock, inflation reignites, and central banks are forced to keep rates high or push them even higher. That's a scenario that extends market pain for months and not just weeks. And the bull case looks more like the Gulf War in 1990, a short contained conflict, an initial panic sell-off, and then markets recover and close the year significantly higher. So what do we do with that information? So what to do with that information? Rather than making a prediction, which you know I don't like to do, and anyway nobody can predict with certainty, let me give you 2 concrete answers depending on how you invest. If you're a trader, I can tell you how swing trading over a higher time frame with a structured plan actually handles this automatically without you having to make any single judgment call. So here's what I mean. Every day, I run my screeners across thousands of stocks. When markets are healthy, the screener is full. More quality setups appear. But when markets turn nervous, the screener starts emptying. Fewer quality setups appear. And so naturally, organically, you slow down. You enter fewer new positions, not because you made a judgment call about an event, but because the market showed you an empty screener. A good strategy runs also on a tiered risk matrix, and it adjusts automatically based on market conditions. As conditions worsen, you're automatically risking less, not because you predicted anything, but because the market tells you which mode you're in. And the third part is about your open positions. And this is the part most people don't think about. Every position you hold already has an exit mechanism running in the background. As a trend develops, you're trailing your stop. If the market turns and that stop gets hit, the position closes automatically, as per the plan. No panic selling, no watching the news, no opinion required about whether this is 1973 or 1990. That's the clean, boring, and beautiful reality of swing trading on higher time frames. The market does the filtering, the plan handles the exit, and you spend 10-30 minutes a day on it. That's all. So what if you're a long-term passive investor? Well, a well-built diversified portfolio is actually designed for moments exactly like this. The whole point of diversification is that when one asset class takes a hit, others absorb the shock and in some cases actually benefit from the volatility. Gold, bonds, certain commodities, they tend to move differently than equities during geopolitical stress. The other thing I'd say, don't touch your rebalancing schedule. Low frequency rebalancing, meaning you leave enough time between adjustments for your assets to actually appreciate, is what keeps you from making emotional, rash decisions every time something scary happens in the news. The worst thing you can do right now is log in, see red, and start moving things around. The goal of a passive portfolio is peace of mind. Easy to follow, low volatility, decent returns, and you can sleep at night regardless of what's happening in the world. That's the whole point. And if you want to go deeper, I actually put a free guide at investorhorizons.com. It's a swing trader playbook, which walks you through exactly how I structured and manage trades. The link is in the description. See you soon.